Hello, everybody, and welcome to the Like a Tortoise channel once again. If you are new here, welcome. Yeah, I do hope you managed to find, you managed to get the most out of these videos. And if you are not, thank you so much for the ongoing contributions, for all the feedback that you guys have been providing. You have been absolutely amazing. And sure enough, I think it was just last week or 2 weeks ago, we had under 100 subscribers. Now we are at 262, and that number continues to increase, which means that I'm just creating value somehow. So yeah, if you don't know what our approach is all about, just refer to previous videos. But we are all about finding high quality companies when they are when they are trading at a substantial discount to the intrinsic value. Okay, so a bit different from what we will see on other channels. We just try to buy not at fair value, but only with a big margin of safety. Because sooner or later, no matter how great the companies are, they all go through periods of uncertainty. Okay, that's been my experience so far, and guys, once again, before I delve deeper into today's very important video that actually feeds into the last video that I shared here, I just want to make sure that we are all aware of the fact that on the 20th of December I am live, so you guys can join if you want, and you can ask me any questions that you want, personal questions, stock market related questions. So I think it's going to be a great time for us to actually get to know each other a bit better. Some of you continue to comment regularly, so I want to get to know more about you guys, and this will be a very good opportunity for us to do that. Okay, now I can see, going back to the videos here. So this some of you are already commenting leaving comments here in this video, and I can see that the number of views has gone up as well. So you guys, probably the fact that I only own 6 stocks in that portfolio managed to raise some eyebrows. But look, I have no problem going all in on a few handful of stocks that I believe very well. And the most important reason is there are no. What makes you think there are so many attractive opportunities in the market right now? And even if you will find attractively priced opportunities, will that meet your criteria for quality? Okay, they suddenly won't meet mine, and they won't meet my criteria for a meaning as well. No matter how great the company is, how great management team is, if I don't like what the company is doing, if I find it boring, then I'm not investing in it. As simple as that. Because if I'm going to have to keep a close eye on quarterly reports, annual reports, so I might as well like what I'm doing. Okay, all right. So today I want to talk about a very important topic that actually brings home what I'm trying to do right now, and that is I want to be very clear about the fact that emotions play a critical role in long-term investment returns, and I want you guys to be fully aware of them. Now, look, I don't come from an accounting or finance background. If you look at my background, I actually studied. We can talk about that on the 20th of December, which is just a few days away. But I have a background in psychology. I also studied human resources, and then I ended up doing a second master's in international business management, where yes, I got exposure to financial analysis. But guys, the most important things that I've learned over time that made me profitable as an investor, they all, I would say 70% has to do with psychology. And don't take my word for it. If you listen to Peter Lynch speak, Peter Lynch, for those of you who are unaware, is a fund manager, a very successful fund manager who compounded money for about 29.9% over 13 years, while in front of the Magellan Fund. So he boasts one of the best track records in history, in the history of finance. And this guy studied arts, and he says many times that psychology is actually more important than algebra or arithmetic. Okay, and I believe that. I think that with the right mindset, with the right framework, the right discipline, you can overcome many of the roadblocks that will always cause most investors to be average. And you guys that are watching this channel, you don't want to be average. I never wanted to be average. Okay, so let's stop behaving as like average people. So, the first thing we need to do is to have a clear understanding of our psychological biases. That will continue to stop us from making rational investment decisions. Okay, by being aware of them, because we cannot cast them out. It doesn't work like that. We are human beings, but we can be aware of them and then we can act upon them. Okay, so I shared the document with our school community that I'm sharing here with you guys right now. Bear with me 1 second. Uh, okay, what's going on here? Okay, let me just minimize this. And I'm going to show you exactly the document that I shared with them and why. In fact, let me just expand this, okay? And why I think this is just so important going forward. And so if you like it, if you like this type of content, also let me know, because I do know quite a bit about psychology. Okay, so the invisible enemies of long-term investing. This is a guide to cognitive biases. Uh, those of you who believe that accounting is going to be instrumental in helping you achieving great returns going forward, you are right. Accounting is definitely the language of business, and so we definitely need to have comfortable with the numbers. That said, this is more important: psychology. Okay, so let's break them down, and then please feel free to share in the comments whether you like this video and if you found it useful. Okay, so aversion is one of them. What it is, we feel losses about 2 times more intensely than gains. This has been scientifically proven. Okay, it's a lot more difficult for us to actually sit on a two time on a lot of games than it is to watch many of our well than it is to it's more difficult for us to watch to be sitting on games than it is to feel losses, right? So for example, an investor sells a high quality stock after a temporary earnings miss because I don't want to lose anymore, and then you end up locking in a permanent loss. Okay, this is one of the things. Selling great businesses after 20-30% drawdown, refusing to rebalance into falling assets. For example, Charlie Munger many times said that Berkshire had 50% drawdowns throughout its history, and that hadn't caused him to panic sell out of the stock. Okay, so if we are clever, yeah, and this is what the best investors in the world do. They actually buy more of those great companies when they become cheaper, and not the other way around. But this is why understanding what we own is paramount. Because if you don't understand what you own, what happens is you will panic at the first sight at the first sign of distress. Okay, recency bias, probably one the most important one, if not the most important one, if I in my opinion. Overweighting overweighting recent events and extrapolating them into the future. Investor behavior: buying what's gone up recently, avoiding what's recently underperformed. We are all guilty of this. I did that mistake many times, exactly because I wasn't aware of this bias until I actually started reading more on it, and it's just pervasive. It just affects so many people, even great investors. I always fight against that. All right, I don't chase. I don't buy stuff that has been significantly hyped up. I try to buy high quality only when it's marked down. And this is what's going to allow us to do very well over the long term. If you do that, you don't need all of your holdings to perform very well. you will need just a handful of them to do absolutely well, and you will achieve greater than average returns. Okay. For example, after 2 bad years for equities, an investor moves to cash right before the market recovers. That's a good example. Okay. In fact, I'm seeing a lot of people now moving to cash. I have no problem with that unless you decide to go all in on cash, which is a big mistake in my opinion. Confirmation bias, another one, seeking information that confirms what we already believe, ignoring negative data about the favorite stock, only following bullish analysts. An investor owns the company and reads only optimistic earnings breakdowns while dismissing deteriorating margins as temporary. A very good example of that is, for example, some of my community members that continue to read everything that is new, everything that is good about the holding. This is, as I mentioned many times to them, confirmation bias. We want to be open minded. I continue to read many negative comments and many negative reviews on Alibaba, Ulta Beauty, and all other investments. Uh, in fact, I make sure that before I even invest in a company, I know exactly what the risks are, what can go against me, and that way I'm better prepared for what's going to be thrown at me at some point. Okay, you have to be comfortable with that. So very, very important. Overconfidence bias, overestimating our skill. So, for example, because Alibaba, as a good example, went up, I assume that, oh, it's because I'm a genius. I've now almost tripled my money, right? I'm a genius. Not necessarily. Likewise, if the stock declined from $70 per share to $50 per share, that doesn't necessarily mean I'm silly. I'm stupid, okay? So it's important to not overestimating our skill, knowledge, or ability to predict outcomes, because the world of investing is full of what? Of unpredictable things, of unexpected events. Concentrated bets without margin of safety, excessive trading. After a few successful peaks, an investor increases position sizes dramatically and ignores valuation discipline. You know that I have no problem going all in on a few handful of companies. That said, I'm not only invested in the technology space because that will be foolish, okay? Just to give you an example. Anchoring bias, fixating on an irrelevant reference point, usually price. I'll sell when it gets back to my purchase price, for example. Valuing stocks relative to past highs, not fundamentals. For example, a stock falls from 100 to 60, the business deteriorates, but the investor refuses to sell because it used to be worth 100. Okay, so Alibaba crashed from $350 per share to 60. Oh, wait a second. Let's load up the truck at 60 because because that is a big margin of safety and the stock is going to go back to 350. No, not necessarily. It may never go back to 350. Okay, I believe it will after doing my own due diligence, but this cannot be extrapolated to every single stock. Many companies are value traps for a good reason. They will continue to be shit. That's the reality. Herd mentality, following the crowd instead of independent thinking. How many of us have been culprits here, right? Investor behavior, buying during bubbles, selling during panic. An investor buys a popular AI stock purely because everyone else is making money without understanding the business, okay? I can't tell you how many people have been buying Nvidia without having clue what Nvidia is doing, which strikes me as shocking, to say the least. But it's just what it is, and this will give us plenty of opportunities because people will always make mistakes, and we will be on the other side benefiting from the mistakes. FOMO, fear of missing out, anxiety about missing gains others appear to be taking. Investor behavior, chasing momentum, buying without valuation discipline. An investor buys a stock after it's already up 300% because this time is different. Okay? FOMO. And this ties into herd mentality as well. Everybody chasing And then, I mean, it's just what it is. We continue to believe it's going to continue to go up, despite while neglecting the sharp increase that the stock just faced. Disposition effect: selling winners too early and holding losers too long. Peter Lynch famously said, selling your winners and what did he say? Selling your winners and holding your losers is like cutting the flowers and watering the weeds. That's what he said. I'm quoting well. Fantastic. Investor behavior: taking profits quickly, letting weak businesses linger in the portfolio. We want to make sure that these businesses, if the moat has been significantly impaired, then they shouldn't have a place in our portfolio. Okay, and no matter so, and even if we are already at a loss, right? If the business has deteriorated, if the fundamentals have deteriorated, if the moat has been breached, then we should get rid of it, no matter whether we are down 20% or 30%, because if the business is shit, it's at one point is going to go down to zero. All right. Narrative biases: preferring compelling stories over hard data, falling in love with visionary founders. Yeah, can I mention Elon Musk here? Yeah, look, I mean, Tesla, for example, I believe Tesla is a cult stock. I believe many people are invested in Tesla not because they understand the business or because the fundamentals are great, because they aren't, in my opinion, but because Elon Musk is a visionary and they fell in love with him. That's what it is. So, example, an investor buys a company because it's changing the world, right? They promise everything, they end up over promising, and then they don't deliver on the promises. That, I mean, it's just what it is. So I stay away from this nonsense. Action bias: feeling the need to do something even when inaction is optimal. Investor behavior: overtrading, reacting to every headline. Example, during market volatility, the investor constantly tweaks the portfolio instead of sticking to a long-term plan. You have to stick to a plan, and we have to filter out noise. Those headlines are made exactly to force you out of your great positions, and that's not going to bode well for you long term, and because it's going to significantly impair your investment returns. Okay. So stick to a framework, and if you are following this channel, the Like a Tortoise approach is fantastic, not because it's from Like a Tortoise or anything like that, but because it's been around for a very, very long time, decades. Okay, I just made a few tweaks, but the core of the framework is there: quality at a big margin of safety. Status quo bias: preferring things to stay the same even when change is rational, keeping outdated holdings, avoiding necessary portfolio rebalancing. For example, an investor holds a low quality legacy stock simply because it's always been in the portfolio. Okay, so after owning Baba for 15 years, I can say, oh my God, this should have a place in here, right? I know the company so well, it's going to continue to be here, even though there is nothing else that we can squeeze out of that company, right? Not good. Remember, the stock doesn't care about you, and neither should we. Availability bias: overweighting information that's most visible or recent in memory, reacting to headlines, overestimating dramatic risks. After seeing repeated news about market crashes, an investor over allocates to cash despite strong fundamentals. Okay, so this is what it is. Availability biases. Endowment effect: valuing assets more highly simply because we own them. Emotional attachment to holdings, ignoring better opportunities. An investor refuses to sell a mediocre company because it's my stock despite better alternatives. And this is always something that you have to consider. And remember that we are talking about, we mean opportunity costs. So if there are other great businesses on my watch list that I want to that I want to allocate a portion of my portfolio to, right? So and if I'm already running a fully invested portfolio, what should I do? If I think the opportunity is better, then I should sell one of my current holdings, um, to adjust that, okay, to adjust my portfolio. And so it's not because that I can have companies in the portfolio for a few years that I'm going to stick with them forever. Absolutely not. And so let's continue here. Sunk cost fallacy: continuing an investment because of past time or money spent. I think this is also very important. So, averaging down into deteriorating businesses, holding mistakes indefinitely. Should you average down into a stock that is down 30% simply because it's become cheaper? No. Number one, just because price has come down, it doesn't mean the stock has become cheaper. Remember that value and price are not the same thing. All right. So, for example, guys, once again, you know very well, and you can check the video that, for example, on um, I'm mentioning Alibaba because we were talking about Alibaba, but I did the same with other holdings like LVMH. I bought more as the company continued to become cheaper, not because not because I believe, not because I was just doing cost averaging for the sake of it. Absolutely not. Because if the business were deteriorating, right, or if something caused me to be on to something caused me to be or to play defense, to want me to play defense, I would take a step back and reassess. Okay, I'm not going to add more to my position until I see this happening. And that's precisely what I did with Evolution AB. I'm not buying more, bringing my cost basis lower because I want to see them turning the business around in China. Very important. And yesterday I mentioned that the only mistake, in my opinion, in my humbled opinion, that I made this year with my portfolio was I doubled down on Lululemon when I should have waited. And I mentioned that even though the stock has gone up 15% after earnings, it doesn't matter. It was still a mistake because I know they still have to turn the business in the Americas around, and they haven't done that yet. Okay, so I should have waited until spring next year to do that. So that was a mistake. Cool. So let's continue. And short-termism: judging long-term investments through short-term outcomes, reacting to quarterly earnings noise, abandoning long-term strategy. An investor sells a strong business after 1 week, quarter, despite unchanged long-term fundamentals. I cannot tell you how many people I see so many people making this mistake, reacting, overly emphasizing quarterly noise instead of focusing on the long term. The same reason could have caused me to sell Alibaba. If I was just gonna focus, if I were just to focus on quarterly earnings, then look at the last quarterly report. Margins have plummeted substantially. Free cash flow is negative. Okay, so that is, wow, what am I doing here? Let me sell. Absolutely not, because I'm thinking long term. And I think, based on everything that I already shared with you in previous videos, I think the company will be in a much better position long term, which is why I'm still holding on to those shares. All right, cool. So let's wrap up this video, guys. And the main conclusion is long-term investing success is determined less by intelligence or information and more by behavior. This document outlines the most common cognitive biases that quietly underlined our performance. And by understanding these psychological traps, you can build more resilient portfolios, improve discipline during market volatility, and increase the probability of compounding wealth over time. And look, another very interesting thing that I'm doing with the portfolio that I created for Like a Tortoise, guys, is I haven't sold a single share yet. Okay, so you will find people on YouTube that have much larger portfolios than the one that I have here, and they will trade more often. I mean, far more often than me. But when you find a great company, chances are you won't have to sell it as often. You won't have to sell it. Hopefully, you won't ever need to sell it, right? Can you imagine how passive this is? You buy into a great business and you just check in with them on a quarterly, annual basis, and you do nothing. And this is what's going to make us a lot of money. Very much like Charlie Munger did. At one point, he only had what, 4 or 5 companies in the portfolio. He hardly ever touched them. I love that. That is definitely the principles that I live by, and I want you guys to. I want to challenge you guys to think the same way, because certainly many companies in your portfolio deserve to be there for a very long time. All right, so guys, I hope you managed to find this educational as well. Let me know in the comments if that was the case. And yeah, man, thank you so much for all your support, for all the feedback again. And I'll see you soon. And remember that the 20th is coming up. So hopefully I will get to know many of you during that live stream. And I'm very looking forward to it. Have a great day and stay tuned for the next video.